What's up, everybody? Jaspreet Singh here, and the newest unemployment numbers came out just a couple of days ago, and they were the lowest unemployment numbers in the last 50 years. It was 3.5% unemployment, which is the lowest unemployment that we have seen in decades, which is great news. However, that unemployment number doesn't give you the whole story, because you're seeing a lot of people say that this is the reason why our economy is so strong, why everything is so great. It's proof that nothing is wrong with our economy. However, this kind of shows you why so many people are constantly surprised by what happens in our economy. It's why so many people get surprised when we saw high inflation. It's why so many people were surprised when we saw the GDP contract for 2 quarters in a row. And now it looks like many people are going to be surprised 12 months from now if and when unemployment starts to rise even more than what we're seeing happen right now. So if I just kind of zoom out a little bit, because NPR wrote a good piece on this, and I just want to go over a couple of the beginning points that they talked about. Then I want to talk about what's really going on with the unemployment number. By the way, I'm in my hotel room right now in Manhattan. I've been traveling, doing a lot of work over here, but I wanted to make sure I keep up with these videos, so making videos from my hotel room. So here's the NPR article. The article starts by talking about how employers in the United States added more than 500,000 jobs in July, which is more than twice what they predicted that employers would add in July. Good news. If people have jobs, that's a good thing. And then it goes on to say that the job market in the United States blew past all expectations, learning that employers are very strong and they're continuing to hire more than what people predict. Now, of course, adding jobs, having people with jobs is a good thing. But what is really causing and helping employers create these jobs? Is it a strong fundamental economy, or is it something else? Well, I have a theory that there is a big chance that the money printing by the government and the Federal Reserve Bank, well, the Federal Reserve Bank's money printing and the spending by the government, have contributed very strongly to this unemployment number, which is good for the short term. But now, as the Federal Reserve Bank is working to increase interest rates and fight inflation, you're going to see the effects of that, and that's going to show its true colors in the unemployment numbers over the next 12 to 18 months. Because if you look at just the number of money printing done by the Federal Reserve Bank, in the end of 2019, the United States government had something around $23 trillion worth of national debt. Today, we're very close to $31 trillion worth of national debt. So over the last 2 years and some change, the United States government has spent about $8 trillion that they didn't have in spending to stimulate the economy in some way, shape, or form. Anytime the government spends money, whether it's in the form of welfare, whether it's in the form of giving businesses something, whether it's in the form of doing some sort of infrastructure, the goal is to stimulate and improve the economy. Because if the government is spending money on infrastructure, well, they say that they're working to improve roads and improve bridges, but they're also creating jobs. Because now you have construction workers that are working, you have engineers that are working, so it does stimulate the economy. So over the last couple of years, we have seen the government spend $8 trillion, which is the most that we've ever seen the government do. Second, we've also seen the Federal Reserve Bank print more money than we have ever seen in the history of time by the Federal Reserve Bank. And we don't actually even have an exact number as to how much the Federal Reserve Bank spent. But even if we look at the very, very, very low end, at the very low end, we know that the Federal Reserve Bank spent at least $6 trillion on some sort of buybacks. These are just asset purchases that the Federal Reserve Bank purchased. Now, again, the Federal Reserve Bank doesn't have $6 trillion sitting around anywhere. They don't have money sitting around. They're not a reserve, even though they're called the Federal Reserve Bank. They have to print this money. So the Federal Reserve Bank printed $6 trillion and used this money to buy up bad assets that were failing. And this also created a big boost for the economy. So if the government spent $8 trillion and the Fed spent $6 trillion, we're talking about, at the very low end, $14 trillion injected into our economy that was just printed out of thin air to boost our economy. Now, what is that going to do? Well, it's going to help build bubble businesses. It's going to help create jobs. It's going to help stimulate and boost the economy in the short term. But then when you try to pull that money out, you're gonna pay the price. Like you can't just print money out of thin air and expect no one to pay the price. Like we're seeing the cost of inflation right now. We're seeing inflation at the highest levels in decades. And so when you print money without actually producing more real wealth, well, then the cost is inflation. The most expensive kind of money is inflation. Now, let's talk about what the cause is and what's going to be coming, because the Federal Reserve Bank in the last few days has given some good indication as to what they want to do in the coming at least 6 months, but we'll see what actually happens. Now, of course, we are covering this on Market Briefs, which is my free financial newsletter. It is a newsletter that I created, one, to just help me stay up to date on what's happening, but then I started marketing it here because I realized that many people want an easy way to stay up to date on what's happening in the top finance and business news. It's completely free, and my team is breaking down what's happening from the stock market to real estate to crypto to inflation to the global economy. I promise you, it is going to be an email that you're looking forward to reading every single morning. I promise you, you're going to love it, and it doesn't cost you anything. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. So now, if we talk about the cost of now trying to fight this inflation, because clearly inflation is still around, everything is expensive, the Fed wants to fight inflation. Well, what does that do? Now, the first thing that happens is the speculative companies get hurt, because these are companies that are not profitable. They've been relying on cheap dollars. They've been relying on low interest rates to stay in business, to operate, to grow, and do all of that. Well, over the last 2 to 3 months, we've been seeing those businesses get hit hard. So all of the tech companies like Robinhood, who also just announced another round of layoffs. We've seen companies like Coinbase, just dozens of companies that are doing layoffs across the tech sector, and a lot of the major tech companies doing hiring freezes and pulling job offers. Now that's expected, right? These are the speculative companies, the companies that didn't have the profits to sustain themselves. But then the second phase is then your more stable companies, the companies that are not in need of external dollars, but then feel the pinch of the slowing economy. And we are starting to see that happen. Like Walmart just a few days ago announced their first round of layoffs, where they're laying off hundreds of people. Now, that isn't a major chunk of the Walmart company, but now you have to just pay attention to where this trend goes. Because as we pull more money out of the economy to fight inflation, somebody's going to have to pay the price for that. And now the person who's going to pay the price is going to be the economy, because our economy has been blown up kind of like a balloon, where you print money and you inflate the balloon with these free and cheap dollars. Well, now this has created inflation, and now we want to pull the dollars out. And this is now what's going to be happening, and we're going to be starting to see the effects of this over the next 12 months, 12, 16, 18 months. It's hard to predict exactly what it's going to be, but as long as the Federal Reserve Bank continues to be aggressive to fight inflation, that is going to push the economy lower. You have a lot of people that keep saying that it's impossible for our economy to enter a recession. There's no way that we're in a recession, although our economy has already been contracting. But as interest rates go up, it's going to continue to contract the economy. Now, this brings us to the question of, what is the Federal Reserve Bank going to do? Because I've been hinting at this we've been talking about this for a long time now. But the ultimate decision maker as to which direction our economy is going to go is going to be the Fed. And you've had a lot of traders and investors in the market essentially say that the Fed is not going to do what it takes to bring inflation down, and they're going to start stimulating and they're going to start inflating, if not by the end of 2022, then in the early part of 2023. Well, this has been kind of becoming more than just a small rumor on the internet to something that you're seeing many people in Wall Street starting to believe as well. And last week, you've seen many Federal Reserve Bank officials now, multiple Federal Reserve Bank officials start to address this, and they have said that no, we're not going to loosen our stance on inflation. Our goal is going to be to bring inflation down to 2%, even if that means that we're going to induce some sort of recession. So if that stays true, because now this is what they're saying with the words, of course, what they do could be something completely different, but this is what they're starting to say, which is a difference in tone of what they said before, because a lot of traders believe that, as soon as we start to see unemployment start to go up, that we're going to see the Fed change their direction and they're going to start inflating, pushing markets higher. Well, now the Fed is coming out and they're saying the opposite. They're saying, well, if unemployment goes up, so sad, so bad, doesn't matter. We're going to continue raising interest rates because we need to get inflation down. And jobs, unemployment is generally a lagging indicator. That's something that happens after the fact because CEOs, business owners are not economists. Their goal is to increase profits as fast as possible. And so if they have cash or they see opportunity, they're going to continue to invest in it. And then if they see the economy slow down, and then if they see revenue slowing down, that's when they're going to make the decision to make cuts and let people go. And so right now, we're seeing the Federal Reserve Bank raise interest rates, and they're saying that they want to continue to raise interest rates. And so if that continues to happen, borrowing becomes more expensive. The economy continues to slow. People are not spending money. That's going to impact businesses' top lines and bottom lines, meaning businesses' revenues and their profits. And if the revenues and their profits get hit, then they're going to start cutting their expenses, aka they're going to start letting more of their employees go. So yes, it is great to see that more people have jobs than ever before. However, take it with a grain of salt because you should expect a great unemployment number when you have injected trillions and trillions and trillions of dollars into the economy. That should happen, that when you inject this much money into the economy and when businesses and people have free money to spend, that is going to create a boom. However, when you're trying to now pop the balloon and let the air out, that's when you see a shift, and that's when you can see a shift in the unemployment numbers. So keep an eye out for this because this is not something that happens overnight, but over the coming months, as the Federal Reserve Bank continues to raise interest rates, you'll start to see this trickle down into the other parts of the economy, and then it'll be interesting to see what actually happens. And this is where I will be keeping you up to date with my team at Market Briefs. So if you haven't subscribed yet, make sure you do that. The dollar has been the world's reserve currency for almost a century now. And now because of all the conflicts going on overseas, we're starting to see more and more countries kind of play this political game. It's like political chess, economic chess, where they don't want to rely on the dollar. They want to move away from the dollar. Now, this is bad news